Now quickly I'll go to few important case laws. RM Arunachalam versus CIT Supreme Court judgment. There first, what is the case? Just listen and understand. That is, let us suppose my father acquired a particular asset by taking a loan from a bank. Now the papers are there with the bank. My father died. That property is coming to me, being a legal heir. Now I approached the banker and asked him to give me the papers. Now the banker says, you repay the loan of your father, then we will give you the papers. Yes, my father purchased that particular asset with 20 lakhs. By paying 12 lakhs out of his money, took 8 lakhs of the loan. Now I am repaying that particular loan of 8 lakhs. Now in this case, what is the cost of acquisition for me? Cost to the previous owner is 20 lakhs and 8 more lakhs I paid. Totally I am saying 28 lakhs. Of course, why the case has gone till Supreme Court? Because are you not inflating the cost? Yes, your father out of his own money 12 lakhs plus 8 lakhs of the bank loan, totally put together 20 lakhs he purchased, and you are only, instead of your father repaying, you are repaying. How come the cost became 28 lakhs? But thanks to the Supreme Court, which said the argument of the SSC is acceptable and we will allow, in case if there is a mortgage created by the previous owner and the SSC repaid that particular amount, then that amount also is to be added to the cost of that particular asset. Based on this argument, there is an SSC who is an intelligent SSC called as Nagender. What he did is, he purchased an asset with 20 lakhs, very hardworking boy. Listened to this particular class, gone to the bank, created mortgage on that, took 8 lakhs of the loan for his marriage. Krishna Reddy is laughing. How come, sir, for the boy marriage girls will spend? No, it's a reverse case. Nagender is a social reformist. He don't believe in taking the dowry. He is a believer of giving the dowry. Okay. Kanya Shulkam. He has paid 8 lakhs by taking a mortgage loan. Now he repaid that particular mortgage loan. Now he says, my cost of acquisition of this particular asset is 20 lakhs with which I purchased and the mortgage which I paid. Sorry, Nagender. It is a mortgage created by you, not by the previous owner. If it is a mortgage created by your father, which you have repaid, yes. That means in the example which we said, Nagender's father took a loan on a particular property. That loan is for Nagender's marriage only. Subsequently, Nagender cleared this particular loan. Yes, then the cost that whatever he repaid the mortgage loan, that you are asked to add it. That is the beauty part of the law. Maybe ultimately the situation is the same, but still that thing, that place, that situation. We have got so many stones, but why only the stone in Hanuman temple is getting every day Abhishekam with milk, Abhishekam with ghee and all, fruits and all, because situation. Okay, like that only here also. So write down this beautiful point. RM Arunachalam versus CIT Supreme Court judgment, that is In case if the legal heirs, in case if the legal heir paid any amount to clear the mortgage, created by the previous owner, then the cost of acquisition in the hands of the legal heir, is the aggregate of the cost to the previous owner and the amount paid to clear the mortgage, So what is the noteworthy point? Note. Another Supreme Court judgment, that is, in case if the mortgage was created by assessee himself, then discharge of mortgage debt cannot be said to be cost of acquisition, or cost of improvement, Of course, now you are very clear. Mortgage created by the previous owner, if it is paid by the present owner, it will be added to the cost. If mortgage is created by the present owner, it will not be added to the cost. Again, exception to every rule. Let us suppose Chakravarti want to purchase a particular building from Krishna Reddy. Chakravarti has got 12 lakhs of his money. Chakravarti entered into a sale agreement with Mr. Krishna Reddy, paid 12 lakhs. On the same day he approached the bank. Bank also granted a loan of 8 lakhs. That 8 lakhs he also took that particular loan of 8 lakhs and paid that 8 lakhs also to Krishna Reddy. Now the case has gone to the Madras High Court. Here the point of the revenue department is what? After the sale agreement is entered, the mortgage is created. So mortgage created by the present owner, if it is getting discharged, it is not to be added to the cost of acquisition. Law is kind enough to say you can't trouble the assets like that. Without that 8 lakhs of the loan amount being taken, he can't acquire this particular asset. So although it is a mortgage created by the present owner only, it is for what purpose the mortgage is created? For acquiring that particular asset. So in a situation where the present owner makes mortgage of the property and takes a debt to acquire that particular asset, then that situation, that mortgage cost also you are asked to add to the cost of acquisition of the asset is a point. Write down. The important point to be noted here is where the SSE purchased a property, and on the same day on the same day, mortgaged property to raise the loan to pay the part consideration comma mortgage expenses incurred comma interest payable on mortgage loan then entire cost of mortgage would form the part of cost of acquisition of the property. So this point you should remember. We now moved through three cases. In first case, straight case, mortgage is created by the previous owner, discharged by the present owner, it will be added to the cost of acquisition. Second situation, mortgage is created by the present owner, it will not form the part of the cost of acquisition. Third is, if mortgage is created by the present owner in order to acquire that particular asset, then mortgage cost will become the cost of the, will be added to the cost of acquisition as a point. See, sometimes it may so happen like there is a property but title is not clear. In order to get a good title or a clear title, if you are paying something, that also is to be added to the cost of acquisition. That is, let us suppose hutment dwellers are there. Unless you remove those hutment dwellers, your property will not get an increased valuation. In order to get an increased valuation to your property and or otherwise to get a clear title of it, if you are incurring some expenditure, it should be forming the part of the cost of acquisition as a point, friends. Now quickly I go through the entire section 47. All what we have done so far is intricate points in section 47. But a general understanding about section 47 also you should have. First thing is what section 47 says: transactions which are not to be regarded as a transfer. First item is what? Distribution of capital asset on partial partition or complete partition of the HUF. Second, any transfer of a capital asset by way of a gift or will or irrevocable trust. Similarly, any transfer of a capital asset in a scheme of amalgamation, and the transferee company necessarily should be what? An Indian company. Similarly, transfer by 100% holding company to its Indian subsidiary, or transfer by a subsidiary company to its 100% Indian holding company of the capital asset, it shall not be regarded as a transfer. There the exception that what we have noted is, if instead of being transferred as a capital asset, if it is transferred as a stock in trade, then it shall be regarded as a transfer, and normal way you have to calculate the capital gains. Then two foreign companies are getting amalgamated. What is getting transferred between them is a capital asset which happens to be the shares of Indian company. See, we have section 9. What section 9 says? Income deemed to accrue or arise in India. In case if the capital in respect of a capital asset which is situated in India, if a transfer is made, even if such transfer is made by sitting in a foreign country, resultant capital gains resultant income shall be deemed to the income accrued or arise in India. So if there are two foreign companies and they are getting amalgamated, in that process of the amalgamation, in case if shares of Indian company are getting transferred from transferor foreign company to the transferee foreign company, then in the absence of the things being stated in section 47, section 9 comes into play and it becomes taxable. But if you tax like that, no foreign companies will acquire the shares in the Indian companies. So thanks to the law for introducing that particular beautiful thing, stating that it shall not be regarded as a transfer, subjected to the condition that at least 25% of the shareholders of the amalgamating foreign company should opt to become the shareholders of the transferee foreign company, and such a transfer should not be taxed in the country in which the transferor amalgamating company is there. इसका मतलब क्या है? Just to make you to remember, I am saying, if Nagendra says that Chakravarti sir, you are not supposed to scold me, then I will only tell to Nagendra, such a situation will arise, my dear. In case if your mother is not scolding you, tell me that day when it will come. That day I will also stop scolding you. Now itself Nagendra says such a situation may not arise. So the point of interest is, when mother scolds the son, why the society should stop? When husband scolds the wife, why the society should stop scolding such wife? Like that only, just to make you to remember this, I am saying that in case if that transferor company where such foreign company is there, that a foreign country in which the transferor company is there, if that country is taxing, we will also tax it. If that country is kind enough to exempt this particular transaction, we will also exempt it. Is a point to be well remembered, is a point, friends. Similarly, today after Chidambaram getting into finance ministry, now being converted into the home ministry, Chidambaram ji ka ek good feeling is that there must be only one bank called as Indian Bank. Towards that direction, our dear ex-finance minister used to always say what? Amalgamate the banking companies. First create North Indian Bank and South Indian Bank, and later on merge these two banks also. During his time as a finance minister, he is more towards corporate restructurings and Indian banking company, small banking companies coming together, thereby what is it, we can compete in the global scenario. Intentions are good. Intention is good, but how to bring it to the practice? Just by giving an exemption in the law? No. Today when I am delivering this particular lecture, the country is undergoing in a very serious problem. What is it? Government is seriously thinking of foreign direct investment into the retail sector also. All our retail businessmen are on the roads yesterday giving a Bharat Bandh. Because whenever you do something also with a good intention also, still there will be certain apprehensions. First apprehensions in the mindset of the people need to be first well addressed before you bring any legislation which is going to ultimately help the country. Whether it's a ruling party or the opposition, the thinking process should be finally to help the people. So now the point here, what for we are discussing all this is, when two banking companies are getting amalgamated, and in case if capital assets are getting transferred subject to the satisfaction of the conditions, what we say, it shall not be regarded as a transfer. Of course, these provisions I am quickly doing it, friends, because these type of clauses and all are relevant only in the year in which such clause is being inserted. But as a general knowledge, you should have this knowledge. Similarly, On one day, Nagendra is doing a painting work. He's a very good painter. मैंने पूछा उसको क्या करते हैं ड्राइंग लेके? I want to give it to the public museum or national art gallery or national archives or a notified museum or to a university. He wanted to give his beautiful drawings and want to get money from them. Then I said there is a beautiful provision, you can very well escape the capital gains tax, because section 47 says in such situation such a transfer of the capital asset being any work of an art, archaeological or scientific or collection of a book or a manuscript or a drawing or a painting being transferred to a government or to the university, archaeological museums and all, it shall not be regarded as a transfer. Of course, now we are coming to the most interesting and important one. In case if bonds are converted into shares or debentures are converted into shares or shares are that debenture stock is converted into shares or debentures, then it shall not be regarded as a transfer. What is the cost to the new asset? Cost of the old asset will be the cost of the new asset, and period of holding of the previous asset is the period of holding is to be added to the period of holding of the present. But the benefit of indexation is to be given from the present date when this particular new asset is coming into existence is a point to be well noted. But please remember, preference shares are converted into equity shares. This principle will not be applicable because it is not clearly stated there that preference shares being converted into equity shares. This principle is not given there. So still, if preference shares are getting converted into equity shares, it amounts to exchange, and according to section 2 clause 47 it is a transfer, and accordingly you have to calculate the capital gains is a point, friends. Then I quickly move to the next issues. A conversion of a proprietary firm, proprietary concern into a company, or conversion of a partnership firm into a company, this also will not give rise to any capital gains burden. That's what I was saying. At one point of time, Chidambaramji's good outlook is corporatization. Let us not encourage the people to do the business in sole proprietary or partnerships. Let us go for corporatization and all. Subsequently, now today we have understood what is the problem with private limited companies. Now we are encouraging slowly reverse kind of thing, limited liability partnerships. At one point of time, the mood is to encourage the people to get converted into corporates. Then now the mood is to again encourage them to go for the limited liability partnership. What an intelligent government. On creation of the company they get money, on dissolution of the company they should get the money, both the times they should get the money, right? In any case, now we are with a beautiful point of conversion of a proprietary concern into a company, or a partnership firm into a company, subjected to the satisfaction of some conditions. It shall not be regarded as a transfer. What are those conditions, friends? First, all assets and liabilities. These provisions are similar to what the definition you have studied in AS 14 for the amalgamation, more or less, except there it is shareholders holding 90% of the share capital should opt to become the shareholders of the purchasing company and all. But here the provision how it is. First is all the assets and liabilities of that particular proprietary firm or partnership firm should become the assets and liabilities of the company. Second thing is all the partners of the firm immediately before the conversion should opt to become the shareholders of that particular company and should continue to hold these shares at least to the tune of 50% of the total share capital. And how they should get the share capital, friends? In the same proportion in which their capitals are standing in this particular partnership firm. And similarly, in case of the proprietor should get share capital to the tune of 50% of the share capital of the company is a point. That is, share capital entitling 50% of the total voting power is a point. So, because of the time factor, I am not asking you to write down that 47 clause 13 and 14, but as a student tomorrow if the question comes, those conditions you need to write, so take care by studying the notes or the standard textbook. At this juncture I am quickly moving to the next point. Our next point here is, as I already told, 47A is there by the side of this 47 clause 13 and clause 14. That is, here what is stated is, one sole proprietary is getting converted into company or partnership firm converted into company. These partners become the shareholders of that particular company. They must hold that particular shareholding for how many years, friends? What is it? For 5 years from the date of succession. And in case within 5 years, if one of the partners completely make transfer or partners makes transfer of their shares, because of that the holding comes below 50%, then earlier allowed exemption will become now taxable, but in whose hands? In the hands of the successor company. Unlike in case of the holding company and subsidiary company transfers, where once 47A comes into play, the taxation is in the hands of the transferor. But here the taxation is not in the hands of the sole proprietary firm or the partnership firm. It is in the succession, that is successor company is a point to be well noted, is a point, friends. Then I quickly get into section 72A, set off and carry forward of losses. What is this set off and carry forward of losses? In the issue which we were discussing, that is a sole proprietary business being converted into company or a partnership firm being converted into a company, then what are all the losses which are there for that particular sole proprietary firm or the partnership firm? They can be well carried forward even with the company. The company can carry forward those losses is a point. So here you just make a note of the synopsis points at least. That is, conversion of a proprietary firm into company. Conversion of a proprietary firm into company. Oblique partnership firm into company. Transfer of capital assets. Transfer of capital assets. In the above situation, shall not be regarded as transfer, subjected to satisfaction of the conditions. Subjected to satisfaction of the conditions. Important condition. Of course, all are important only, but when I say important from your examination point of view, important condition, the aggregate of the shareholding of the company, the aggregate of the shareholding of the company of the partners oblique sole proprietor is not less than 50%, is not less than 50% of the total voting power, of the total voting power in the company and their shareholding continue to be as such, their shareholding continue to be as such for a period of 5 years, for a period of 5 years from the date of succession, from the date of succession. That is most important condition. Next, in case if there is a failure to satisfy this condition, in case if there is a failure to satisfy this condition, then 47A comes into play. Then 47A comes into play, and earlier allowed exemption would become taxable, as the income of the previous year in which there is a violation of condition, in which there is a violation of the condition. And accordingly tax will be levied in the hands of whom? In the hands of the successor company. I think students will be able to better appreciate the point. If a violation of conditions is there, if there are any violations of the conditions, in case of holding company transferring to subsidiary company or subsidiary company to the holding company, their point is earlier completed assessment will undergo further rectification. Earlier completed assessment will undergo further rectification. Whereas in this case, earlier completed assessment will not get rectified. This income will be taxed as the income of the successor company, that too also of what? Of the previous year in which the condition is violated is a point. So this is one important distinction. As a students you should well be able to get the clarity is a point. Now I take up that carry forward losses, that is section 72A. In case if the conditions of section 47 clause 13 and clause 14 are met with, then the accumulated losses and unabsorbed depreciation of the predecessor shall be deemed to be the loss or the allowance, shall be deemed to be the loss or the allowance of the successor company for the previous year in which such business reorganization was affected. Friends, please remember, you should well understand this point. Let us suppose there is a sole proprietary or a partnership firm. It got losses. It waited for 7 years whether it can earn the income and set off these losses. Not possible. In the 8th year, they decided to go for conversion of proprietary or partnership firm into company. Again, a fresh lease of 8 more years will come. To whom? To the successor company. That is the beauty part. That is a beauty part in case of amalgamations and in case of sole proprietary firms and partnership firms being converted into companies. But this beauty part is not there in case of demergers. In case of the demergers, only for the balance period the successor is allowed to carry forward these losses. Anyhow, that beautiful discussion we can have in the set off and carry forward. But in case of business reorganizations of amalgamation and sole proprietary firm or firm getting converted into company, again a fresh lease of 8 more years will be there for that particular loss to be carried forward, is a point to be well remembered. Then in 47 we have another concept called as conversion of membership of a stock exchange. Other way around, it is to be put like this: conversion of stock exchange into a company. That is, stock exchange is there. Earlier stock exchange used to be in which format? AOP, Association of Persons. Now that is getting converted into company. At that point of time, what is happening? That is, the members are going to give up their membership to the company, and in lieu of that giving up of the membership, they are going to get the two things: demutualization. One is the shares of the company, second is the trading and clearing rights. Earlier also we have discussed. It shall not be regarded as a transfer is what we are discussing in section 47. What is the cost of acquisition of those shares? Cost of that particular membership which they have given up, that will be the cost of acquisition of the shares. What is the cost of acquisition of the clearing rights? Is a cost of acquisition shall be taken as a nil, is what the point we have discussed. At this point only we are saying that you should regard it as not, you should treat it as not to be regarded as a transfer, is a point. So with these aspects we covered maximum points in the section 47. There are few more aspects also in the 47, which we will give quick review in the discussion to follow.